12 years ago, we were just like most investors. We thought property was all about rental income, flipping houses, buying below market value, and chasing the next big area. And to be fair, it kind of worked. But after working with hundreds of investors and seeing the real long-term results of more than £100 million invested every year, our thinking evolved. We started looking deeper at what actually delivers consistent compounding returns over time. And what we found was so effective, we built our entire approach around it. So in this video, I'll show you the one-page plan we now use for every investment, why it works even in flat markets, and how you can use it to build long-term wealth. Before we go any further, if you want to follow along with this as we break it down, you can download the actual one-page investment plan using the link in the description. It's the same framework I'm walking you through in this video, laid out clearly so you can see how each piece fits together. So grab it now, keep it in front of you, and let's keep going. Most investors think that rental income is the key to making money in property. Either that or snapping up a neglected semi and flipping it for a hefty profit. And yeah, if you know what you're doing, you can make money that way. But these are just side effects. What really makes property so powerful over time is something hardly anyone talks about, and that is inflation. Inflation is normally our enemy when we're buying a pint, a loaf of bread, or a Freddo. I think Freddos have actually risen faster than inflation, but anyway. For property investors who use a mortgage wisely, inflation can be an ally. To show you what I mean, let's say you buy a £200,000 property with a £50,000 deposit and a £150,000 interest-only mortgage. And let's imagine the value of that property grows by just 2% a year on average, which is extremely conservative. After 10 years, that £200,000 property is now worth around £250,000, and you still owe just the £150,000 you borrowed in the first place, which means your equity has doubled from £50,000 to £100,000 without you having to lift a finger. That's more than a 7% annual return on your cash, excluding rental income, produced purely from your property going up in value by 2% per year. Now let's say you did renovate that property, or you bought it at a discount, or you bought in an area that's growing faster than average and where rents are going up too. These are all absolutely achievable and can make your returns all the more spectacular. My point is, let inflation work for you, not against you. This is the core idea behind our entire plan. And of course, if you're basing your whole investment plan around one single factor, you need to be damn sure it's going to continue. And in the case of inflation, I'd say it's not just likely, it's inevitable. Let me explain. So over the last 10 years, the average UK house price has risen from £188,000 to £270,000. That's an increase of more than £80,000, and it wasn't the result of a property boom or once-in-a-lifetime market timing. All house prices did was match inflation, which averaged 3.8% each year. And in an uncertain world, it's one of the few economic forces that's almost guaranteed, because the Bank of England's job is to keep inflation at around 2%. When it drops too low, they pull every lever at their disposal to push it back up, from printing money to cutting interest rates. But if inflation drifts above 2%, it's a different story. Sure, near double-digit inflation like we had a couple of years ago was a massive problem. But if it's running at 3 or 4%, there's far less urgency to fix it, and they wouldn't want to risk causing job losses or damaging confidence by going too far. And that's why the long-term average inflation rate has been higher than the official target ever since the official target has existed. And so, even though we tend to see inflation as a villain, it can actually work to your advantage. Because when you use an interest-only mortgage, your debt stays fixed for the whole term, while the value of your property and the rent you charge usually increases with inflation over time. Of course, prices and rents don't match inflation every single year. Sometimes they'll grow faster, sometimes slower. But zoom out, and the long-term pattern couldn't be clearer. So even if house prices just keep pace with inflation, your equity compounds. Which is why, when using our one-page investment strategy, it's crucial that you structure your finances around inflation instead of seeing it as something to avoid. But once you've adopted that mindset, where do you go next? Well, a few years ago, one of our clients bought a canal-side flat in Manchester for £199,000. Same building, same spec as the other units, but thanks to a bit of negotiation and good timing, we secured them a price that was £22,000 less than everyone else was paying. Now, even if the value of that flat only grows in line with what inflation has actually averaged over the last decade, that single decision puts their annual return at over 9%, before you even factor in rental income. But the thing about capital growth is that it doesn't happen evenly across the UK. So if you chase cheap properties without considering what's happening in the wider area, you might be in for a shock. Growth follows jobs, regeneration, infrastructure, and population growth. Manchester, for example, has grown 68% over the last decade, whereas old favourite London has grown at just 13%. So if you want property prices to do the heavy lifting for you, you need to buy in a high growth area that's actually showing signs of long-term demand. Look for major cities or strong commuter towns, especially those with clear signs of regeneration, growing populations, and good transport links. Because otherwise, that bargain could leave you with slow growth, problem tenants, and endless repairs and renovations. And while we're on the topic of repairs, I've got some bad news about period properties. Because a few years ago, Zoopla found that on average, older homes cost £700 a month in maintenance and upkeep. That's the equivalent of a whole extra mortgage payment. Broken boilers, leaky roofs, and dodgy electrics are just a few issues that can quietly drain your time, money, and patience. And if you're trying to build a portfolio, those issues don't just eat into your returns. They can throw you off course completely. We've seen plenty of investors who started out strong only to get worn down by repair costs, voids, and flaky tradespeople. They ended up throwing in the towel before inflation had had time to do its thing. That's why we focus on new or newish stock. Yeah, the ceiling might be lower, the garden might be overlooked, and it's not going to have the same character or charm. But if it means I don't have to spend my weekends ringing around for a plumber and I can forget that I own it for months on end, that's a trade-off I'm more than happy to make. Remember, you're not chasing the highest possible yield, and you don't need to beat the market every year. To make the most of inflation, you need to stay invested for the long term. And you can only do that if you also stay sane. We once spoke to an investor who proudly told us he'd paid off half his mortgage within 5 years. He'd bought a £200,000 property with a £100,000 mortgage, but instead of leaving it on an interest-only deal, he started overpaying, hundreds each month, and he got the balance down to £50,000 in record time. That may look like progress, especially if you consider yourself risk-averse, but here's the thing. Another investor bought a similar property at the same time, but took a very different approach. She used a 75% interest-only mortgage, fixed her rate for 5 years, and kept her monthly payments low. Instead of overpaying, she saved her cash and used it 2 years later as a deposit on a second property. Fast forward 5 years. Investor 1 has one property, low debt, and around £90,000 in equity. Investor 2 has two properties, higher debt, but nearly £160,000 in equity, thanks to capital growth on both homes. Investor 2 used leverage to her advantage and let inflation do the heavy lifting. And that's the paradox most investors miss. Debt feels risky, but in property, not using it properly can be the bigger risk, because you're taking on all the risk, hassle, and lumpiness of property without making use of the one huge advantage that it has over other asset classes. You can easily and relatively safely secure large amounts of debt against it. So here's what we recommend. Fix your rate for 5 years so your numbers are predictable. Go interest only to maximize monthly cash flow and flexibility. And start at 70 or 75% loan to value and let it drop naturally as values rise. Your mortgage will naturally pay itself down relative to the property's value over time without you having to do anything. So if you want to build serious long-term wealth, smart leverage is one of the most powerful tools you've got. A few years ago, I was seriously considering selling off parts of my portfolio. Not because the numbers didn't work. They did. It was because every time I tried to focus on growing my business, I'd get a call about a minor maintenance issue, or a late rent payment, or a tenant giving notice. And this was with letting agents in place. But even then, things kept finding their way back to me. Eventually, I hired a part-time assistant just to act as a buffer. Someone who could speak to the agents, handle the admin, and only come to me when absolutely necessary. And that changed everything. Nowadays, I barely think about the properties day to day. But the equity continues to grow, the rent still comes in, and the plan keeps ticking away in the background. Because here's the thing most investors overlook. The biggest threat to this strategy isn't the market or interest rates or regulation. It's you. Because if your portfolio starts to feel like a second job, you'll find a reason to quit before the real gains kick in. Meaning you'll miss out on all the stuff I said earlier about inflation doing the heavy lifting while you get on with your life. So instead of trying to do everything yourself to save a bit of money, why not build a hands-off system that lets you step away? It's easier than you might think. First, you want to use a proactive and highly rated letting agent who won't immediately bounce every issue back to you. Once you get beyond your first couple of properties, bring in someone to help manage the managers. even if they're only part-time. And of course, use mortgage brokers, bookkeepers and accountants rather than even dreaming about taking on all that stuff yourself just to save a bit of money. Because this isn't about squeezing every penny. It's about staying in the game long enough to let the plan do what it's designed to do. So now you've got the full one-page plan, and you've seen how powerful this can be when you follow it properly. But even with the right plan, it's easy to slip up. We still see smart investors making the same 3 expensive mistakes. And if you don't want that to happen to you, watch this video next where I break down these mistakes and how to avoid them.